At exactly the moment when most retail traders were doom-scrolling charts and influencers were recycling yesterday's headlines, the real market cleared its throat, and that cough echoed through steel doors and underground corridors where no camera is allowed. Because this story doesn't start on a screen, it starts in a vault, and if you're just still believing price is whatever flashes on Comex, you were already 3 moves behind. Tonight, Deutsche Bank wasn't trading. It was cornered, forced to deliver 3 million ounces of silver, not in theory, not rolled forward, not netted, but physically, painfully real. The kind of delivery that rattles balance sheets and wakes lawyers at 3 a.m. And while the public saw nothing but a flat chart, inside the system, alarms were ringing. Because delivery is the one thing paper markets fear, and this delivery wasn't optional. It was demanded by entities that don't tweet, don't explain, and don't wait. Deutsche's problem wasn't the metal, it was the timing. Because JPMorgan was already positioned, already loaded, already sitting where the river bends, ready to scoop up nearly 80% of what was about to move, and this wasn't competition, it was extraction. A clean grab executed with precision that retail traders romanticize but never actually experience. Because retail doesn't get invited to wars like this. Retail gets the recap after the damage is done. Here's the uncomfortable truth you need to swallow early if you want to survive markets instead of narrating them. Price discovery doesn't happen where you think it does. It happens when someone can no longer say no, and tonight Deutsche couldn't, which is why trucks rolled, manifests were signed, and ounces changed hands while YouTube thumbnails screamed about breakouts that never came. This is the moment the retail eagle myth quietly died. Because while small players were waiting for confirmation candles. The biggest predator on the field was already eating, and if that makes you uncomfortable, good discomfort is the first sign you're finally paying attention. Understand the structure here. This wasn't a single trade. It was the resolution of pressure built over months, maybe years. A slow tightening where paper promises multiplied faster than physical reality until one side finally said, deliver not later, not cash. Settled now. And when that demand hits, everything else becomes irrelevant, including your indicators, your narratives, and your favorite analyst's confidence. Deutsche ES forced delivery wasn't to just about ounces. It was about credibility because every forced physical settlement exposes the fragile lie underneath leveraged metals. Markets the lie that supply is infinite as long as contracts can be printed, and JPM understood this better than anyone, which is why they weren't scrambling, they were waiting. Because predators don't chase, they position, and when the moment comes, they let gravity do the work. This is where you need to stop thinking like a spectator and start thinking like a strategist. Because the lesson here isn't banks are evil or markets are rigged. Those are lazy conclusions for people who want comfort. The real lesson is harsher. Power flows to those who control optionality, and retail, by definition, has none. Not because they're stupid, but because they're late, fragmented, and emotionally attached to narratives instead of logistics. Tonight, logistics won. Steel doors beat digital charts, and 3 million ounces spoke louder than 1,000 influencers ever could. As JPM absorbed nearly 80% of the flow, it wasn't a victory lap. It was inventory management, cold, silent, efficient. The kind of move that doesn't need applause because its reward is future leverage. Leverage over supply, over spreads, over the next crisis that retail will only notice when prices gap on a Sunday night. If you're feeling angry reading this, good. That anger means you're starting to see the blind spot. The one where you assumed the game was fair because the interface looked clean. This channel exists for one reason, to rip that illusion apart piece by piece, not to sell you hope, not to feed you dopamine, but to teach you how real power actually moves in markets. And if you can't handle that, unsubscribe now and go back to comfort content. But if you're still here, if you want to understand why retail eagles went extinct while banks feast, then you need to stay, because this is only chapter 1, and the next chapters will get uglier, more precise, and far more useful than anything you've been told before. So subscribe, not because it feels good, but because ignorance in markets is expensive, and this story has just begun. If you thought the battle was only about ounces of silver, you've already underestimated the terrain. Markets aren't just charts, they are engineered ecosystems where every move is tracked, every counterparty assessed, and every weakness exploited before you even hear the word spread. The real battlefield of this story isn't Comex. It's the network of vaults, clearinghouses, and private agreements that exist behind the public eye. Retail traders operate in the daylight, looking at charts, hoping price will move their way. Banks like JPMorgan and Deutsche operate in tunnels, literally and figuratively, where price is a byproduct of control, not a signal. On the night Deutsche was forced to deliver 3 million ounces, the hunting grounds were alive, and everyone playing in the open was already a step behind. Picture this. Deutsche's risk desk, normally a quiet command center, was now a pressure cooker. Alerts flashed on multiple screens simultaneously, but screens aren't reality. Contracts are reality, and reality doesn't care about technical analysis. One wrong move, one late delivery, and the dominoes would fall. That is the beauty and the horror of physical settlement. It doesn't negotiate with charts or sentiment, it demands compliance. Every ounce Deutsche didn't to have on hand could have triggered cascading failures across counterparties. But they did have it, which made the move even more dramatic. It was a forced exhale of metal into the hands of the only entity with the infrastructure to immediately absorb it, JPM. And JPM wasn't greedy in the human sense, they were strategic, calculating how to consolidate 80% of the flow without creating a market ripple big enough for retail to even notice in real time. Now here's where most people miss the point. This isn't about owning silver, it's about controlling optionality. Optionality is the ultimate leverage, and JPM has it in abundance. Every ounce they received isn't just an asset, it's a potential market-moving weapon. Need to squeeze shorts? Deploy. Need to stabilize your books? Deploy. Need to leverage scarcity to extract concessions from other banks or hedge funds? Deploy. Meanwhile, retail traders, those eagles perched on forums and Discord servers, were blind to this because they never see the infrastructure behind the screen. They only see the numbers, the tweets, the analyst insights, and by the time they react, the move has already happened, leaving them frustrated and often wrong. This is why the term retail eagles gone isn't hyperbole. It's literal. The night Deutsche delivered, millions of ounces flowed into a system where the small guys simply don't exist. The retail trader who thought they could front run, hedge, or even react in time was already too late. They didn't have the leverage, the vaults, the credit lines, or the settlement agreements. Most of them didn't even understand the rules of engagement. They think liquidity is continuous, that market depth is infinite. It isn't. Physical metal has constraints. Contracts can be printed endlessly, but deliveries can't. And that is the moment the predator-prey dynamic becomes crystal clear. The prey can cry manipulation all they want, but it's not manipulation, it's logistics, precision, and optionality. Three things retail almost never masters. Meanwhile, on JPM's side, the planning had been months in the making. Every contingency was mapped. Where Deutsche would fail or bend, JPM would be there. Every vault location, every shipping schedule, every legal loophole had been scrutinized. They weren't reacting. They were executing a playbook written in advance, a playbook invisible to the average trader because it isn't discussed in newsletters or YouTube videos. This is the kind of market participation that makes the difference between losing a fortune and quietly gaining $100 million without anyone noticing. Retail, by contrast, reacts to momentum indicators and social media hype. You can already see why survival here is almost impossible unless you start thinking like the players who move mountains behind closed doors. And then there's the optics of it. For the casual observer, the price barely moves. COMEX reports deliveries as a number on a spreadsheet. The headlines may say Deutsche delivers silver or JPM absorbs supply, but these are sanitized, simplified versions of what is essentially a war fought in silence. The truth is that the price impact is delayed, sometimes by days, because the market absorbs the flow methodically. JPM doesn't dump or spike, they integrate and control. By the time retail notices, the game has shifted, the narrative has been rewritten, and the advantage has already been extracted. If you want to survive, you can't wait for news. You have to anticipate the moves that news eventually confirms. Here is a harder truth most people want. Tell you, the physical metal market is ruthlessly intertwined with trust and credit lines. Deutsche delivering 3 million ounces isn't just a logistical task, it's a test of counterparty reliability. If Deutsche had failed, JPM could have forced defaults, triggered margin calls, and essentially reshuffled the risk landscape overnight. That is the silent leverage most retail never sees. It isn't just silver, it's the ability to influence the behavior of multi-billion-dollar institutions. And make no mistake, this leverage is asymmetric. JPM has it, retail doesn't. And that gap is why the Eagle story ends here. The retail narrative is easy to understand because it comforts ego. I'm smart, I see the charts, I'm prepared. But preparation without infrastructure, optionality, and a network that can act at scale is irrelevant in a forced delivery scenario. The night Deutsche released 3 million ounces, retail was effectively spectator sport. They were watching a war they weren't invited to. And while some will call this unfair, the brutal truth is that fairness has nothing to do with survival in markets. Execution, control, and timing are the only currencies that matter. If you're still reading this, you need to internalize another lesson. These chapters aren't just for entertainment. They are a blueprint for understanding why conventional retail strategies fail in crises of scale. The silver isn't just silver. It's a vector for understanding leverage, logistics, and influence. And the next chapter will show how JPM didn't just collect metal. They reshaped the battlefield, setting up a domino effect that will influence every ounce traded in the coming months. This isn't a story you read for fun. It is a lesson you apply if you want to avoid being a victim of the next forced delivery. So, if you haven't already, hit that subscribe button. Not because it's polite, not because it's trendy, but because the people who survive these moves are the ones who seek knowledge before the headlines arrive. Every chapter from here on will peel back another layer, revealing the structures, the players, and the moves that determine who wins and who is left out in the cold. If you want to see how retail eagles went extinct while banks feasted, and if you want to learn the principles that could prevent you from repeating the same mistakes, subscribing isn't optional. It's necessary. Markets are messy, brutal, and often invisible. The night Deutsche delivered 3 million ounces, a war was quietly won and lost simultaneously. Retail was left outside, watching, hoping, and largely helpless. Understanding why requires more than charts. It requires recognizing who really controls the game, why they do, and how they plan months in advance to turn opportunity into dominance. That is the hunting ground. That is the lesson. In the next chapter, we'll go deeper into the consequences of JPM's control, showing how the ripples of a single forced delivery travel far beyond the vaults and into every account that dares to think it can compete without infrastructure. This is real market warfare. And if you want to survive, there's no time for distractions. The story continues, and it will get more intense, more revealing, and more actionable than anything you've read before. When Deutsche Bank delivered those 3 million ounces, it wasn't just a singular event. It was the opening salvo in a chain reaction that few outside the inner circle even recognized until it was too late. Most retail traders look at the market as if it exists in isolation. One day silver goes up, the next day it goes down, and price charts dictate emotion. That's not how it works in the real arena. The market is a living network of obligations, contracts, and leverage, and when one node, like Deutsche, is forced to act, the entire web quivers. The ripple spreads first through vaults and clearinghouses, then to hedge funds, then finally, painfully, to retail accounts, long after the damage has been done. Retail thinks they are trading in real time, but by the time confirmation hits their screen, they're already reacting to yesterday's war, not today's reality. Consider the timing. JPMorgan had already positioned themselves months in advance. Their trading desks, risk analysts, and logistics teams knew exactly when the pressure point would come. They didn't need a chart showing retail eagles circling. They had the contracts, the vaults, the settlement agreements, and most importantly, the knowledge that Deutsche was forced to deliver. The moment the first truck rolled out, JPM's algorithms began recalibrating risk exposure, not in theory, but in concrete ounces. They absorbed nearly 80% of the flow with surgical precision, leaving just enough liquidity in the market so price appeared stable, preventing retail from sensing the magnitude of the event in real time. This is why the phrase, retail eagles gone, isn't a metaphor, it's literal. The small players were left out of the actual distribution, observing a war they weren't invited to, powerless to intervene. Now, let's break down what happens in these domino moments. When Deutsche delivered, hedge funds with leveraged positions began to react, not because they wanted to, but because the settlement triggered margin calls and collateral adjustments. This creates a cascading effect. Firms that were long paper silver suddenly need to liquidate positions to meet requirements, driving temporary distortions in price. Retail, seeing these moves on the chart without context, thinks it's a sudden breakout or breakdown. But in reality, it's an echo of a war fought in private vaults. For those who understand the structure, this is predictable. If you know the players, you know the consequences. But for most retail participants, it feels chaotic, unfair, and random, which is exactly the point. Markets at this level are engineered to make the unprepared look foolish. The fallout doesn't stop there. Banks like JPM aren't just collecting ounces, they're reshaping the battlefield. By absorbing the bulk of Deutsche's delivery, they consolidate optionality. Optionality is power. It allows JPM to decide the future of supply in the market. Do they release some to manipulate spot price? Do they hold it as a strategic reserve to squeeze shorts later? Do they use it to negotiate with other banks, hedge funds, or even governments? The answer is all of the above. Each ounce represents leverage far beyond its market value. Retail traders, on the other hand, see only price movement. They don't see leverage. They see losses or gains, which is why most never learn the deeper game. Here's the psychological impact. Retail participants, already emotionally invested, are forced to chase. They see a slight uptick in price and think, now I can enter, or they see a dip and panic sell. In reality, these moves are engineered reactions, secondary effects from a forced delivery executed in silence. The channel that delivers this story exists to make you aware of these hidden layers, to teach you that survival requires more than charts. It requires thinking several moves ahead, understanding supply chains, and recognizing leverage points invisible to casual observers. If you don't internalize this, the domino effect will crush you the next time a forced delivery occurs, and it will, because this isn't a one-off, it's a systemic feature of leveraged commodities markets. The global implications are even more profound. When one major bank is forced to deliver millions of ounces, it impacts international positions. Other banks watching the settlement adjust their hedges. Large traders outside COMEX adjust funding lines, margin requirements, and risk models. This creates a secondary layer of dominoes that can impact Forex, interest rates, and other commodity markets. What retail sees as silver moving is actually a network of realignments across continents, a ballet of risk adjustment that happens faster than human eyes can follow. If you think your local broker's chart captures reality, think again. By the time retail reacts, the game has shifted, and if you haven't learned to anticipate these shifts, you'll always be one step behind, a spectator to your own losses. Let's talk about the cold mechanics of JPM's strategy. When Deutsche delivered, JPM absorbed 80% of the metal. This was not a defensive move, it was aggressive positioning. Aggressive positioning doesn't mean price manipulation, at least not in the conventional sense. It means controlling the distribution of supply. By consolidating physical ounces, JPM can influence future contracts, manage spreads, and dictate the timing of subsequent releases. Retail traders chasing breakouts are effectively chasing shadows, reacting to the physical flows they cannot access. Understanding this mechanism is crucial if you want to survive the next delivery cycle. Ignorance will cost more than money. It will cost credibility, opportunity, and confidence in your ability to play in these markets. And here's the final layer most people ignore: information asymmetry. The average retail trader gets filtered information, charts, news articles, tweets, but nothing about the operational realities of vaults, delivery schedules, and counterparty obligations. Meanwhile, banks like JPM have a complete view of these flows. They know not just the quantity, but the timing, the routes, and the potential bottlenecks. This is why they can operate silently and effectively while retail panics or hesitates. Without access to this information, retail is essentially gambling, while JPM is executing strategy. By now, the message should be clear. The domino effect unleashed by Deutsche's forced delivery is more than a market event. It is a structural demonstration of why retail traders often lose in a system built to reward scale, optionality, and timing. Physical deliveries expose fragility, and those who cannot access physical optionality are always at a disadvantage. Retail eagles, no matter how sharp they think they are, were left watching a war from the bleachers, while the real players consolidated power and prepared for the next wave. This is why subscribing to this channel is critical. We don't just tell you what happened. We break down the mechanisms, the structures, and the strategy behind the headlines. Understanding the domino effect is not academic. It's survival. Each chapter of this story equips you with insight, context, and the perspective needed to anticipate rather than react to the next forced delivery. If you stay only in the chart-based world, you're doomed to repeat the same mistakes, watching the same pattern of retail failure unfold again and again. The next chapter will go deeper, exploring how JPM's consolidation affects retail positioning, margin exposure, and the future of silver as both a market and a geopolitical lever. It's one thing to know that forced deliveries happen. It's another to understand how they change the rules for everyone else, silently, invisibly, and permanently. For now, internalize this. The dominoes aren't hypothetical. They're real, measurable, and devastating if you're unprepared. Deutsche delivered, JPM absorbed, retail panicked, and the stage was set for the next act in a market war most will never see coming. If you want to be more than a spectator, if you want to survive these cycles, stay with this channel, absorb every detail, and learn the structures of power that dictate every ounce, every contract, and every move in the game. By now, you should be starting to understand that what most people call the market is actually a carefully choreographed system of control, influence, and leverage. When Deutsche Bank was forced to deliver 3 million ounces of silver, the headlines framed it as a simple transaction. But in reality, it was a full-scale demonstration of strategic dominance, executed in silence. JPMorgan, absorbing nearly 80% of the flow, wasn't just buying metal, they were rewriting the rules of engagement for the next several months. Retail traders, waiting for charts to confirm a breakout, had no idea they were already several moves behind the real game. This chapter breaks down how control is exerted in markets like this, why it's nearly impossible for small players to compete, and how understanding these dynamics could keep you from being a victim of the next forced delivery domino. First, let's talk about optional positioning. When you hear traders talking about being long or short, what they usually mean is a position on paper. But the real advantage lies in the ability to deliver or withhold physical supply. Every ounce JPM absorbed from Deutsche wasn't just an asset, it was leverage, a way to influence price without even trading. Think about it. If you hold the majority of supply, you can affect spot pricing indirectly by creating scarcity or abundance, strategically releasing or withholding metal to force reactions from hedged positions. Retail traders have no such ability. They are spectators. Even if they own silver, they don't have the infrastructure, contracts, or vault access to dictate terms in a way that matters on the scale JPM operates. Optionality is control, and JPM has it in spades. Second, consider the art of quiet absorption. Most retail traders assume that big moves in price come from visible trades, but in reality, the real play is invisible. JPM didn't scoop up Deutsche S ounces in one giant transaction. It was executed with surgical precision across multiple accounts, clearinghouses, and vaults. The goal was not to move the market immediately, but to integrate the metal in a way that minimized ripples. Why? Because moving price too fast would trigger panic among retail participants and hedge funds alike, creating chaos that could backfire. By quietly absorbing 80% of the delivery, JPM maintained control while allowing secondary and tertiary market participants to act, thereby creating reactions that further consolidated their advantage. This is why retail eagles were gone. They weren't invited to the table, and by the time they tried to react, the environment had already shifted against them. Next, there's the leverage of scarcity perception. Even though silver exists in the world in abundance, its distribution in terms of immediate deliverability is extremely limited. JPM understood this. By holding the majority of delivered ounces, they could subtly influence narratives around supply constraints. Spot prices might show minor fluctuations, but the perception of scarcity affects margin requirements, future spreads, and leverage positions everywhere. Retail traders, seeing these fluctuations, might think, I need to get in before the price spikes, not realizing that what they're reacting to is a carefully managed illusion of shortage. In effect, JPM controls not only the metal, but the narrative, the story that drives panic, euphoria, or hesitation among smaller participants. Another critical element is risk management through infrastructure. JPM isn't just a bank, it's a network of vaults, contracts, and legal contingencies designed to absorb shocks that would cripple anyone else. They know where every ounce can be stored, how long it takes to move, and what regulatory frameworks allow or restrict immediate delivery. When Deutsche delivered, JPM could execute without stress because their entire system was built to anticipate, absorb, and capitalize on exactly this kind of forced movement. Retail traders, by contrast, operate on digital platforms with delayed settlement and no physical optionality. This is why being small isn't just inconvenient, it's strategically irrelevant in certain market scenarios. Then comes the domino of secondary markets. Absorbing physical ounces isn't the endgame, it's the setup. By consolidating metal, JPM positions themselves to influence not just spot pricing, but also futures contracts, options, and leverage positions globally. Hedge funds holding leveraged positions are forced to adjust when physical supply consolidates, because their risk models suddenly signal higher exposure. This triggers margin calls and forced liquidations, which can then be fed back into JPM's strategic cycle. Retail traders, chasing charts, have no insight into these multi-level interactions. They see only price action on a screen, unaware that the entire system is moving as a consequence of a delivery they weren't part of. Let's not forget the timing advantage. Banks like JPM aren't reacting, they're predicting. The entire system operates with knowledge of who can deliver, who cannot, and what triggers forced action. By the time Deutsche's delivery was made, JPM had already aligned multiple accounts, vaults, and contracts to receive it with minimal friction. Timing in this context is not just about execution speed. It's about predicting triggers, understanding secondary reactions, and managing ripple effects across global markets. Retail traders, dependent on delayed information, are always at a deficit in timing. Every reaction is late, every opportunity is stale, and every forced move is a trap set before they even click buy. The psychological impact on retail is enormous. Watching price oscillate without understanding the underlying flows creates desperation. Traders chase moves, increase leverage, and often compound losses. The narrative becomes, markets are manipulated, I'll never win, when in reality it's not manipulation, it's structured dominance. The rules are different at scale. Banks operate in a system of information and logistical advantages that retail can't access. Retail eagles are gone not because they aren't smart, they are gone because they playing a different game entirely. A game where losing is statistically inevitable if you don't understand the rules. Finally, this chapter is about education and survival. If you want to operate beyond spectator status, you need to internalize these principles. Optionality beats paper positions. Quiet absorption beats. Impulsive trading perception can be as powerful as physical supply infrastructure, enables leverage, timing defines control, and multi-level consequences determine real outcomes. Ignoring these lessons ensures that when the next forced delivery occurs, retail will again be left out, scrambling to react to events already concluded behind closed doors. This channel exists to expose those hidden structures, so you don't repeat the same mistakes. If you haven't already, subscribe. Not for entertainment, not for dopamine hits, but because survival in markets like these depends on knowledge, not luck. Each chapter builds a strategic framework that helps you understand why retail eagles vanished during Deutsche AES forced delivery, and what you can do to avoid being sidelined in the future. This is more than a story. It's a manual for seeing beyond charts, beyond headlines, and beyond the illusions most traders mistake for reality. The next chapter will explore the aftermath, showing how the flow of these 3 million ounces reshaped futures markets, margin requirements, and retail psychology over the following weeks. The war isn't over after delivery, it evolves, and those who understand the evolution thrive, while those who don't are casualties of delayed information and structural disadvantage. This is the silent strategy of control. It's not flashy. It doesn't appear on charts. It doesn't make headlines. But it determines winners and losers with ruthless precision. Deutsche delivered. JPM absorbed. Retail panicked. The battlefield has been redrawn. And if you want to survive it, subscribing and paying attention isn't optional. It's essential. By the time the 3 million ounces were safely in JPMorgan's vaults, the story had already begun to echo outward in ways that retail traders would painfully feel but barely understand. This chapter isn't about price charts, it's about the invisible shockwaves that ripple through accounts, contracts, and leveraged positions when a forced delivery occurs. The reality is harsh. Retail eagles didn't just fail to participate. They were set up to react late, emotionally and expensively. Understanding this requires digging into the mechanics of collateral, margin calls, and cascading failures, the very structures banks like JPM exploit to consolidate power, while retail scrambles in the chaos. First, let's talk about leveraged positions, because this is where the casualties begin. Retail traders often overestimate their influence on markets, forgetting that most speculative positions are built on leverage, not actual ownership. Leverage amplifies gains, but more critically, it amplifies losses. When Deutsche delivered 3 million ounces, JPM absorbed 80%, tightening available physical supply. Hedge funds and retail accounts with leveraged long positions suddenly faced the hidden truth of risk. Collateral requirements had shifted. Even a minor perceived scarcity can trigger algorithms to demand additional margin or force partial liquidation. Retail traders, often unprepared, receive margin calls in real time without context, panic, and liquidate at precisely the wrong moment. What seems like random losses is actually a carefully orchestrated consequence of physical flows that retail cannot access. Next comes the domino of forced liquidation. When one leveraged account is liquidated, it creates price movement that triggers other accounts to react. This isn't random, it's predictable if you understand the chain of dependencies. For example, if retail trader A is forced to sell due to a margin call, the resulting dip in price can trigger a stop-loss cascade for trader B, trader C, and countless others across platforms. Each reaction is delayed, emotional, and inefficient. Meanwhile, JPM, with knowledge of the flows and the ability to execute quietly, can benefit from these ripple effects without any aggressive intervention. Retail mistakes this for market manipulation or bad luck, when in reality, it's the natural consequence of being late, leveraged, and structurally disadvantaged. Collateral exposure is another key factor. Most retail traders don't fully grasp how collateral works. When you buy paper silver with leverage, your broker isn't giving you metal, we're giving you access to a claim against the system, backed by your cash and their credit lines. If the system shifts through forced deliveries, physical consolidation, or unexpected scarcity, your collateral suddenly becomes insufficient. Your broker issues a margin call. If you can't meet it, your position is liquidated automatically. The beauty, from JPM's perspective, is that this entire process is self-reinforcing. Each forced liquidation contributes to price movement that benefits those with optionality, creating a feedback loop that punishes latecomers. Let's examine the psychological collapse. Retail traders are emotionally attached to charts, patterns, and narratives. When a forced delivery triggers margin calls, they see numbers moving against them and panic. This isn't just financial, it's behavioral. Fear and desperation lead to poor decision-making, closing positions too early, doubling down in the wrong direction, or exiting entirely. Meanwhile, JPM and other well-capitalized institutions don't panic. They have pre-planned scenarios for every possible move. Emotional attachment is the weapon of the late entrant, and the system is designed to exploit it. The collapse of retail confidence is as much a consequence of psychology as it is of physical deliveries. Now consider the ripple into futures and derivatives. Forced physical delivery doesn't just affect spot prices, it reshapes the landscape of associated contracts. Futures contracts, options, and leveraged derivative positions all reference the same supply base. When JPM consolidates physical ounces, the effective supply available for settlement contracts shrinks. Futures spreads widen, volatility increases, and margin requirements spike. Retail traders, often unaware of these interconnections, suddenly find themselves overexposed. Their positions aren't just losing money, they're at risk of cascading liquidation across platforms. By the time they understand the mechanism, the market has already shifted, leaving them trapped in positions engineered to fail without optionality. The structural lesson here is brutal but necessary. Retail eagles cannot compete in markets dominated by institutions with optionality, infrastructure, and foresight. The forced delivery is not an isolated event. It is a systemic feature designed to reveal weaknesses in those who trade without access to the mechanisms that enforce control. Every margin call, every liquidation, every emotional decision by retail participants strengthens the position of the institutions who prepared months in advance. In other words, the market doesn't cheat. Retail simply misunderstands its rules. Here's the hidden consequence for retail participants. Capital erosion isn't just about losses, it's about opportunity cost. Every forced liquidation reduces buying power, shrinks flexibility, and diminishes the ability to participate in future cycles. JPM, absorbing the ounces quietly, now has the ability to influence next month's deliveries, next quarter's spreads, and next year's settlement obligations. Retail, already weakened, is structurally locked out from regaining parity. The system isn't fair, and it isn't meant to be. It's a network where scale, optionality, and foresight dominate, and missing a single structural lesson can be financially fatal. Another dimension is network contagion. Hedge funds, brokers, and other institutional participants watch the forced delivery unfold. Positions are adjusted, contracts hedged, and exposure recalculated globally. Each of these moves further tightens the environment for retail traders who remain leveraged and exposed. The moment Deutsche delivered, the network shifted subtly but irrevocably. Retail, trying to follow charts and news feeds, sees only the outcome, not the process. By the time panic sets in, the system has already reshaped itself around the institutions with power, leaving retail reacting to a story that was written days or even weeks earlier. At this point, the lesson is unavoidable. Preparation beats reaction. Retail traders reacting to forced delivery are already behind. The events we're analyzing didn't start with Deutsche's truck. It started months earlier with positioning, credit lines, and strategic foresight. The channel you're watching exists to illuminate those hidden layers, to teach you how institutional players think, and to reveal why small participants are often casualties, not due to incompetence, but due to structural reality. Understanding the domino effect of collateral collapse is not optional. It's survival knowledge. If you're following this story and haven't subscribed yet, now is the moment to do it. Not for entertainment, not for hype, but for survival in a system where delayed understanding equals financial injury. Every chapter builds on the last, showing how forced deliveries, physical optionality, and collateral management interact to create systemic advantage for institutions and systemic disadvantage for retail. Missing a chapter isn't just missing context. It's missing insight into how to prevent your account from becoming part of the collapse narrative. The next chapter, Part 6, will reveal the aftermath and strategic lessons. It will detail how JPM's consolidation of Deutsche's delivery reshapes market narratives, future optionality, and the potential for retail participants to rebuild if they internalize these lessons. We'll break down survival strategies, not the generic advice of buy low, sell high, but the structural, operational, and psychological approaches that allow you to operate with awareness in a system designed for scale. For now, internalize this. The collapse of retail positions following Deutsche's delivery is predictable, structural, and systemic. Forced deliveries expose vulnerability, and without optionality and foresight, retail participants are collateral in a war they never saw coming. Understanding the mechanics of leverage, margin, and liquidation isn't optional. It is how you survive the next cycle when physical flows collide with speculative enthusiasm. The dust from Deutsche Bank's forced delivery had barely settled before the full scope of its consequences became visible, but only to those paying attention. For retail traders, the chaos felt random, even cruel. Positions had been liquidated, charts had oscillated violently, and confidence had eroded. But for JPMorgan and the institutions aligned with them, this was the calm after the storm, the moment when advantage crystallized and future leverage was secured. Understanding what happened in this aftermath, and how it shapes every subsequent move in silver and related markets, is essential for anyone who wants to survive, adapt, and eventually thrive in a system built to favor those with scale optionality and foresight. The first impact was market psychology. Retail participants, seeing prices fluctuate erratically, assumed the market had turned against them overnight. They blamed manipulation, conspiracy, or bad luck, when the truth was structural. Forced deliveries redistribute risk and optionality in ways that retail cannot access. The mental toll is enormous. Traders lose confidence, doubt their analysis, and hesitate in the next cycle. Many exit the market entirely, reducing competition and inadvertently consolidating control in the hands of those who remain prepared. In effect, the collapse of retail eagles strengthens the very entities that orchestrated, or at least capitalized on, the delivery. Understanding this psychology is crucial. Markets are as much behavioral as they are financial, and institutional players exploit both. Next, consider position consolidation. By absorbing 80% of Deutsche's delivery, JPM not only acquired physical metal, but also influence over the immediate settlement market. This allowed them to set terms, dictate pricing indirectly, and manage the release of supply in ways that would maximize strategic advantage. Futures spreads, options premiums, and margin requirements all became subtly adjusted in response. Retail, having been liquidated or shaken by margin calls, had no leverage in this environment. The game had shifted, and without understanding this, small traders are left reacting to conditions they cannot control. The after effects are not temporary. They cascade, shaping every subsequent market event, until the next forced delivery or supply squeeze occurs. Another critical outcome was the reallocation of risk. Every forced delivery changes counterparty exposure. Banks, hedge funds, and other large players monitor who absorbed what, how collateral shifted, and where potential weaknesses now exist. JPM, having integrated the Deutsche delivery into their system, now had the ability to manage risk strategically across multiple channels. They could reduce exposure in volatile markets, hedge selectively, and even exert subtle pressure on counterparties who were less prepared. Retail, on the other hand, had no insight into these reallocations. Positions were already compromised by forced liquidations, and any attempt to re-enter or adjust risk was inherently reactive. This asymmetry is why survival requires not only knowledge, but anticipation. We also see the evolution of narrative control. After the delivery, mainstream commentary focused on price movements and technical charts. Few journalists or analysts explained the structural mechanics, physical consolidation, forced delivery, and the chain reaction of margin calls. This narrative vacuum benefits the institutions who orchestrated or benefited from the delivery, because retail is left to interpret events through incomplete or misleading lenses. The story becomes about luck or manipulation, not structural dynamics. Subtle control of perception is as powerful as control of supply. Those who understand the mechanics see opportunity. Those who follow headlines are trapped in cycles of panic and delayed reaction. The aftermath also highlighted the limits of traditional trading tools. Retail traders often rely on technical indicators, sentiment analysis, and news feeds. But when physical deliveries and institutional optionality dominate the market, these tools provide little foresight. Charts react too slowly. Social sentiment lags. The actual determinants of price, vault positions, delivery obligations, and large-scale optionality remain invisible. Survival depends on shifting from reactive analysis to structural understanding, identifying where risk resides, how optionality is distributed, and when forced events can shift the market entirely. Ignoring this distinction guarantees repeated losses. Here's the most important lesson from this aftermath. Awareness creates opportunity. Once the forced delivery had redistributed silver and capital, a strategic player with foresight could begin planning for the next cycle. By monitoring institutional flows, settlement schedules, and supply bottlenecks, an informed trader could position themselves in advance, reducing risk while preparing to benefit from secondary effects. This doesn't require guessing the exact price. It requires understanding the system, its vulnerabilities, and the recurring dynamics of forced deliveries. Retail eagles who adapt in this way may never match the scale of banks, but they can avoid being systematically crushed. The final aspect of the aftermath is the structural reset. Every forced delivery reshapes market hierarchy. JPM consolidated control, retail positions were liquidated, and hedge funds adjusted exposure. The system has a new baseline. Supply distribution has shifted, risk exposure has been recalculated, and confidence among retail participants is weakened. The lesson is clear. In order to compete or survive, you must understand the new baseline, anticipate the next pressure point, and adjust your strategy accordingly. This is not optional for serious traders. Ignorance guarantees you will repeat the same mistakes every cycle. To summarize the long-term implications, first, physical deliveries are not random. They are structural stress tests that reveal systemic advantages. Second, optionality and infrastructure are the ultimate form of leverage, far beyond what charts or sentiment can deliver. Third, margin calls, forced liquidations, and collateral exposure cascade through the system predictably, punishing unprepared participants. Fourth, narrative control amplifies advantage by ensuring retail interprets events through incomplete information. Fifth, the aftermath sets a new baseline, shaping future market conditions for months or years. Understanding all of these factors is not theoretical. It is survival knowledge. This chapter, and this entire 6-part story, exists to teach you one core principle. Markets reward those who understand structural dynamics, not those who rely on hope, luck, or reactive strategies. Deutsche's forced delivery and JPM's strategic absorption demonstrate how scale, optionality, and foresight create winners, while delayed information and leverage vulnerabilities destroy retail eagles. If you want to survive in this environment, you must internalize these lessons and adapt. Passive observation or traditional analysis will not protect you. Awareness, anticipation, and strategy are mandatory. If you followed the story this far, the next step is action. Subscribe to this channel not for entertainment, but for survival knowledge. Future chapters, updates, and insights will continue to dissect the structural forces in commodities, metals, and leveraged markets, giving you the context and tools to think ahead rather than react. Knowledge is optional. Survival is not. Every forced delivery will repeat the lessons we've covered, and those who internalize them will have a fighting chance. Those who ignore them will continue to be collateral in a game designed for scale, structure, and control. Deutsche delivered, JPM absorbed, retail collapsed. But the aftermath is not the end. For those willing to study, learn, and adapt, there is a path forward, a way to anticipate forced deliveries, manage risk, and operate with awareness in markets that are brutal, silent, and unforgiving. Understanding the aftermath is the key to turning chaos into strategy. That is the lesson, the warning, and the roadmap for anyone serious about surviving and thriving in the real world of commodities.